Thank you, and welcome back to the Briefcase, where we talk all things business, investing, and real estate. Today, we're going to be talking about real estate vocabulary words, starting with CO. Let's get into it. There's a moment in real estate where the conversation just changes. You walk into a room, someone says co-investment, contingency, co-op, and suddenly it sounds less like English and more like a private language for people making serious money. Today, we're decoding that language, not randomly, not loosely, but precisely. We're breaking down 20 real estate terms, all starting from CO in alphabetical order. So by the end of the video, you won't just understand the conversation. You'll sound like you belong in it. Let's get into it. Co-borrower. A co-borrower is exactly what it sounds like. Someone who takes on a loan with you. But here's the nuance. They're equally responsible, not partially, not symbolically, fully. If the mortgage gets paid, great. If it doesn't, lenders don't care who missed the payment. They care that both of you signed. Co-brokerage. Co-brokerage is when two brokerages collaborate on a deal, usually one representing the buyer, the other the seller. The translation: there's more cooks in the kitchen, but ideally, there's better food. When it works, deals move faster. When it doesn't, you've entered a negotiation gridlock. Co-insurance. This one lives in the insurance world. Co-insurance means the property owner and the insurance company share the risk. If you're underinsured, you don't just get less coverage, you get penalized, which is a polite way of saying cutting corners here can get expensive. Co-listing. A co-listing is when two agents share the responsibility of listing a property. Sometimes it's strategy, sometimes it's necessary, and sometimes it's two personalities learning patience in real time. Co-maker. A co-maker is similar to a co-borrower, but typically it's used in smaller or personal loans. They're backing the loan with their credit, which means they trust you a lot, or they didn't read the fine print. Cooperative housing or co-op. A co-op flips the normal ownership model. You don't own the unit. You own shares in a corporation that owns the building, which means you're not just buying a home, you're joining a system. And yes, they can reject buyers. This is where real estate meets an admission board. Co-ownership. Co-ownership is when two or more people own a property together. Sounds simple until you realize decisions now require consensus, whether it's repairs, selling, or refinancing. The ownership is shared, so the decision making and the potential conflict is also shared. Co-signer. A co-signer guarantees a loan without actually owning the property. They're your financial safety net, or more accurately, the bank's safety net. If things go sideways, they're on the hook without ever getting the keys. Co-tenancy. Co-tenancy refers to multiple tenants sharing a lease or space. In commercial real estate, it can also mean one tenant's presence affects another's lease terms. For example, if a major anchor store leaves, smaller tenants might have the right to reduce rent because traffic matters a lot. Co-tenant. A co-tenant is simply one of the individuals sharing the property. Same lease, same responsibility, different habits, which is where things get interesting. Collateral. Collateral is the asset backing a loan. In real estate, that's usually the property itself. If you miss payments, the lender doesn't argue. They just take the asset. It's not personal. It's in the contract. Collections. When a borrower stops paying, the debt can go into collections. At that point, it's no longer a friendly reminder. It's escalation, credit damage, legal action, and persistent calls. You get the full experience. Commercial real estate. Commercial real estate includes properties used for business, whether it's offices, retail, or industrial spaces. The rules here are different. Longer leases, bigger numbers, more variables, and often more opportunity. Commission. This is how agents get paid. A commission is typically a percentage of the sale price. It's performance-based income. No deal, no paycheck, which explains the urgency you sometimes feel. Common area. A common area is shared space, whether it's hallways, lobbies, or amenities. In residential, it's convenience. In commercial, it's calculated value, because well-designed shared space increases foot traffic, and foot traffic increases revenue. Community property. In certain states, community property means assets acquired during marriage or jointly owned. That includes real estate. So yes, property ownership can get very legal very fast, especially when things don't go as planned. Comparables or comps. These are similar properties used to determine value. Same area, same size, recent sales. This is how pricing becomes strategy, not guesswork. Concessions. A concession is something a seller offers to sweeten the deal. Maybe to cover closing costs. Maybe they include appliances. It's negotiation disguised as generosity. Condemnation is when the government takes private property for public use, also known as eminent domain. You'll get compensated, but not always the number you choose. Contingency. Contingency is a clause in a contract that says this deal only works if this condition is met, whether it's inspection, financing, appraisal, or anything else. It's your exit strategy built in to the contract. And just like that, you've gone from hearing these terms to actually understanding them. But more importantly, you now understand the pattern. Real estate isn't just about property. It's about structure, risk, and relationships. In the language we just covered, that's how things are controlled. Now, if you've made it this far, I would like to say thank you. And if you found any of these vocabulary words insightful or confusing, make sure to leave a comment down below. And if you enjoyed this video, make sure to like it and subscribe. Now remember, stay smart.